You're listening to a production of the National Media Archive. To learn more or volunteer, go to nationalmediaarchive.com.
Have you noticed how fortunes are being amassed in the UK today at a scale not seen since the Victorian era? Over the past decade, the number of billionaires in Britain has exploded, with more than 50 officially calling the country home. In fact, at least 30 people now earn over £500,000 a year. That's not just a statistic, it's a seismic shift in who holds economic power. Now, you might be thinking, does this make the rest of us better off? We've often been told that wealth at the top trickles down, fueling growth and opportunity for everyone. But let's posit, does that economic tide really lift all boats, or just the super yachts? What's driving this boom isn't a new gold rush or the next industrial revolution. Instead, it's a set of financial techniques and global flows of capital that have redefined how fortunes are made. Think of it like a high-stakes game where the rules are written by and for the players at the top. Let me tell you a story. London's skyline has transformed, not just with glittering buildings, but with the influx of international wealth. The city has become a magnet, offering safety, luxury, and access to global markets. But behind the champagne and caviar is a system that rewards risk-takers often at the expense of everyone else. So as we dive into this wealth surge, ask yourself, who really benefits? And more importantly, what are the hidden costs for the rest of us? Why has London become the go-to hub for the international elite? For starters, the city's financial services sector contributed a third of the UK's economic growth in recent years. That's not just bankers crunching numbers, it's an entire ecosystem, from luxury real estate to high-end restaurants and exclusive clubs. Imagine arriving in town with billions to invest. You're chauffeured in armored limos, whisked through congestion-free streets, and out to private airfields. It's a lifestyle of almost unimaginable privilege, and it fuels demand for properties like a £50 million North London mansion or a 26-bedroom estate with running costs over £1 million a year. But behind the scenes, the technical term asset appreciation is at work. Picture the value of homes, art, even entire companies soaring not because of new inventions, but because global money is chasing limited assets. Now you may wonder, is this just harmless glamour, or is there more at stake? When local families are priced out of entire neighborhoods and new ghettos of ultra-wealth are created, the city's very fabric begins to change. So next time you walk past an empty mansion or see a Rolls-Royce gliding by, remember, London's transformation into a capital of capital is both a symbol of opportunity and a warning of growing divides. Here's where things get technical, but stick with me. Following the dot-com crash in 9/11, the U.S. Federal Reserve slashed interest rates to historic lows, just 1%. This isn't just an American story because finance is global. Suddenly, money became cheaper to borrow for everyone, everywhere. Now, you might ask, how does a drop in interest rates in Washington ripple through to your mortgage in Manchester? It's all about liquidity, the technical term for how much cash is sloshing through the system. Cheap borrowing means not just individuals, but tycoons and financial institutions could take on more debt than ever. With this flood of credit, asset prices from paintings to penthouses soared. People borrowed more against the rising value of what they already owned, creating a feedback loop of ever-increasing debt and asset inflation. But here's the conflict. Central banks said their job was to control price inflation, not asset bubbles. So, as markets rose and the borrowing binge intensified, oversight lagged behind, leaving the stage set for both spectacular gains and looming risks. The resolution? Well, that's still up for debate. But remember, cheap money can be a double-edged sword. What fuels a boom can also set the stage for a bust. Ready for some financial wizardry? Enter leverage, a technical term for using borrowed money to magnify your investment returns. Here's a simple analogy. Imagine putting down £10, 0 on a 100, 0 house, borrowing the rest. If the house jumps to 110, 0, your stake doubles, even though you only put in a fraction of the money. Now, apply that principle to billion-pound deals. With debt so cheap, the financial elite borrowed mind-boggling sums to buy property, art, and even entire companies. The more they borrowed, the bigger their gains, so long as prices kept climbing. But there's a catch. Leverage isn't just a magic money machine. If asset values fall, losses are magnified too. It's like skiing faster and faster down a mountain. You can get to the bottom first, or you can crash spectacularly. Now you might be thinking, isn't this just smart business? Up to a point, yes. But when entire industries pile on debt, the risks can spread far beyond the original investors, eventually impacting everyone. So, the next time you hear about record profits or bonuses, ask how much of that success is built on borrowed money and what happens if the tide turns. Let's talk about taxis, a topic that may sound dull, but it's at the heart of the new super rich's success. In the late 1990s and early 2000s, policies shifted to attract global wealth, making Britain a land fit for billionaires. Lower taxes for the wealthy, especially those with international income, became the norm. But here's the conflict. While early political rhetoric promised to end offshore tax breaks for millionaires, the reality changed. The fear? That the ultra-rich would simply leave, taking their investments and the jobs they create with them. Technical term alert non-domiciled status allowed some to live in the UK for decades while paying little or no tax. As you might guess, this raised eyebrows not just among the public, but even among some of the super rich themselves. Now, you may ask, is it fair for hedge fund managers to pay a lower tax rate than their own staff? Even some insiders call this palpably absurd. The setup creates a widening gap where the benefits of growth are concentrated at the top. So, the big question, should tax policy prioritize attracting global talent or ensuring fairness for all? The answer shapes not just who gets rich, but the very fabric of our society. Now let's dive into the world of private equity, a sector that's redefined corporate takeovers. Private equity firms use vast amounts of borrowed money to buy out entire companies, aiming to boost their value and sell for a profit. Here's the technical bit. Leveraged buyouts, or LBOs, mean you're buying a business mostly with debt, not cash. If things go well, the returns are enormous. If not, well, it's usually the company and its employees who pay the price. Let me tell you a story. Some of Britain's best-known brands, think VA, Saga, Homebase, Have, been bought, overhauled, and sold for billions in profits. The super rich behind these deals often walk away with more than most workers could earn in a lifetime. Now you might ask, is this just clever entrepreneurship or something more troubling? The answer lies in incentives. When the system rewards risk-taking with other people's money, the risks can be social as well as financial. Private equity success is amplified by the macroeconomic environment, cheap money, favorable tax policy, and a willingness to take big bets. But as we'll see, not every gamble pays off. If you think private equity sounds high stakes, wait till you meet hedge funds. Hedge funds are financial powerhouses that use complex strategies like short selling and derivatives to bet on price movements in everything from stocks to currencies. Picture this. A handful of traders managing billions can move entire markets with a few keystrokes. And because many are based offshore, they often sidestep traditional regulation, making them both agile and opaque. Now, you might be wondering, what's the risk? Hedge funds can earn astronomical returns. Some managers pocketed over $500 million in a single year. But their bets are highly leveraged, meaning losses can be huge and sudden. Here's the setup. If a hedge fund loses money, it's usually the investors who take the hit, while the managers keep their fees. This asymmetric risk incentivizes bold, sometimes reckless behavior. The resolution? Calls for regulation are growing, but as the financial world evolves, hedge funds remain the ultimate risk takers, sometimes with systemic consequences. Now, let me introduce you to the magic trick of modern finance. Structured finance. This technique transforms risky loans like subprime mortgages into investments labeled as ultra-safe, such as AAA-rated securities. Here's an analogy. Imagine mixing 3 shaky loans together and slicing them up so that some investors get first dibs on repayments while others take the leftovers. The technical terms here are tranching and securitization. Now, you might wonder, isn't this just creative banking? In theory, yes, but in practice, it spread risk throughout the global financial system, often to investors who didn't realize what they were buying. Conflict arose because rating agencies, paid by the banks, often gave these packages their highest safety marks, sometimes without checking the borrower's ability to repay. The illusion of safety let the boom keep building. So, the resolution? When reality hit and borrowers defaulted, the entire system was exposed, leading to panic and, eventually, financial crisis. Here's where all these threads collide. In 2007, the seemingly unstoppable boom came crashing down. Subprime loans, those risky mortgages, began defaulting at record rates. The complex securities built on them suddenly lost value, and no one could tell who held the toxic assets. Think of the technical term liquidity freeze. Banks stopped trusting each other, money markets seized up, and some institutions faced collapse overnight. Remember Northern Rock? Its business, built on selling repackaged mortgages, unraveled almost instantly. Now you might ask, was this inevitable? In hindsight, the warning signs were everywhere, but the system's complexity and incentives blinded many to the risks. The result was a vicious cycle: falling prices, rising defaults, and a collapse in lending. Let me tell you a story. Families like Elena Hall's faced eviction, while the very people who engineered the boom often walked away with their fortunes intact. The losses estimated in trillions were socialized, while profits remained private. The resolution? Governments and central banks had to step in, bailing out institutions deemed too big to fail. But the damage to the broader economy and public trust was profound and lasting. So, what's the legacy of this age of global greed? While the super rich may have lost some paper wealth, many remain insulated, enjoying luxury goods and exclusive experiences that defy wider economic woes. The technical term moral hazard captures the core problem. When those taking the biggest risks are shielded from consequences, they're incentivized to do it again. As central banks slashed rates and pumped cash into the system, the cycle of boom and bust threatens to repeat. Now you may wonder, can anything be done? The answer lies in changing incentives. That means rethinking fee structures, strengthening regulation, and confronting the reality that the rules of the game favor the few over the many. Let me leave you with a question. If the same structures and incentives remain, are we destined to see another round of risky bets and spectacular crashes? Ultimately, rewriting the rules is essential if we want prosperity that's sustainable and shared by all, not just the winners of the global greed game.